This is a complete breakdown of every single fee in an IUL from ages 50 to 80. Welcome, my name is McCluskey. I graduated near the top of my class in industrial engineering with a track in econ and finance. I happen to love breaking down the numbers in spreadsheets. So today we are going to take a look at every single fee, every single year, from premium charges to coverage charges to cost of insurance to bonuses they'll sometimes credit you to even offset those fees, and finally summing it all together, what percentage of your cash value is actually being shelled out every year, and is it worth it? Let's get into it. In this example, we have a 50-year-old moving over $1 million in 4 years in 1 day into the policy, and then we have all of the fees that come with that. The very first thing we're going to notice, that's our premium. Then we have our premium load charge. So this is our first charge. You can see each time we put premium in, there is going to be a premium load charge. So you can see here, in the first year we put in $223,982. There was a charge of $13,215. So if we take that divided by it, it's about 5.9% of the premium we are putting in is going straight to the premium load charge. Even in the 5th policy year, we can see here it's just about the same. Here it's about 5.8997%, so about the same. And then we have our admin and rider charges. This is almost always going to be $120 a year forever. And then there would be additional fees if you did have any riders. In this example, we did not find it necessary, and most of the time we're not going to add any anyways. So that's super small portion there. Whether you're putting in $200,000 a year or $12,000 a year, that fee is still going to be there. So technically, the more you put in, the smaller of a percentage this is, but it's almost negligible. Next, we have our coverage charge, and you're going to notice this is the largest of them all. In this specific example, we have it spread out over the first 5 years. Depending on the company or the product you use, this can be spread out between 5 and 15 years is the longest I've actually seen. Each time you get a policy, you are going to have, this is sometimes otherwise called the per 1,000 base charge. These are the fees that are front loaded. So like when you pay a mortgage down, a lot of times how the interest is paid up front, same deal with the IUL. We have our premium load charges, we have our coverage charges. Those are being paid up front. They're fee heavy in the beginning. And then as the policy goes on and we hold it for long term, and we're using this as a long-term vehicle, that's where we're going to actually see our net internal rate of return start to be a very solid number. So in this case, when we get the fees over and done with in just 5 years, really just want to get it all done with up front and let the policy grow, we can see if we took the coverage charge divided by the premium outlay in this example, that is almost 14% of what we put in. So a lot of people, when they see that fee, are really going to freak out and say, wow, that is a big charge. I don't know if this is worth it. I don't really like products that have fees. And it's a valid concern if they're looking at this as a short-term vehicle. IUL is exactly the opposite of that. It's a long-term vehicle. We pay our fees up front, but if we actually want it to average out and have it be a strong internal rate of return, we've got to stick in for the long run. So this is going to be our biggest charge. In this product, we got it done in 5 years. Sometimes they'll spread it out even longer. Last but not least, in our charges, we have our cost of insurance. You can see here it starts at $1,010 and it continues to get bigger. Well, because we have an annual renewable term built into our IUL policy, of course, as we get older, what's happening to our cost of insurance? Well, we're more likely to die, so it's going up. However, since our cash value is also growing, the gap between our cash value and our death benefit is getting smaller and smaller and smaller and smaller. So the amount of insurance we're actually paying for is also getting smaller. So even though our cost of insurance is actually going up as a dollar amount, in terms of a percentage of our cash value, it's actually getting cheaper as we get older. And then something that you'll almost always want to do is when you are done funding the policy, you want to drop the death benefit to the minimum. This is something you want to make sure that your agent does. But you can see here in this year, so that's going to be year 14 and 15, the death benefit drops. How do we know that? Why? Because we look at our cost of insurance and it just randomly drops from $3,472 to $1,356. So this is a big deal. You always want to drop the insurance to the minimum when you're done funding or the earliest that they'll allow you to do it. And that's something that when the year comes, either the agent or the person has to actually manually call in and make sure that that is done. This is why it's so important to have an agent that's staying in the industry and is going to do annual reviews. And also, even if not, that they're educating you so you know what to do if they were not there. Next to that, we have our total charges, just summing up all of those together. And then what a lot of companies will do is they'll actually give you a bonus credit. This is also otherwise known as a persistency credit. Since you've been with them for this many years, this starts in year 11 in this example, we're going to start giving you a bonus so that not only will it offset all of your fees for this year, but actually exceed it. And this can play a big role in looking at that net internal rate of return in your later policy years, because while you might pay 24% in year one, if you're getting a bonus in year 11, when your total fees is $32.53, your bonus is $11,043, well, if you earn 7% that year, you're not going to have a fee. They're actually going to pay you a little bit of a fee in some sense. And if that continues to happen year over year, you can see how your internal rate of return is really going to start to catch up from those early year policy fees. The last couple things we're going to look at here, one is our policy surrender charge. This isn't a charge that's being applied each year, but this is the charge you would have to pay if you were going to completely surrender the policy. So that's just this number, the accumulated value, minus the surrender value. So if you want to surrender the policy, you only get the surrender value. You're not going to get the full accumulated value. So if we over here do accumulated value minus surrender value, you'll see that equals 74,696, which is the same number right here. That's where they're getting that number from. And here you have it, your policy charges as a percentage of your accumulated value. So this is going to show you the actual percentage you want to see. Look at the first 5 years. Very fee heavy, 24.7, 12.06, 7.83, 5.71, 4.27. It's no wonder, as we mentioned earlier, a lot of people look at IUL and think, wow, they're very heavy in fees, therefore I'm not going to use it. But look after year 5, what happens? 0.23, 0.25, 0.26, continue to scroll down, 0.08, 0.11. It continues to get lower. Now if we look at the column next to it with bonuses, again, our early years are still going to be very heavy, the exact same actually, because the bonuses don't kick in until year 11. And once they do, what happens? We see a massive change in terms of our percentage of our cash value being allocated towards our fees. So all of these numbers are great. It hopefully gives you a little bit better picture of what's kind of going on with our fees inside of an IUL. But what do they mean? What's the point? How do I know what this data means? How do I know if it's even worth it? What we did to answer that question is if I scroll over here and scroll down a little bit, you can see right here, I ran an internal rate of return calculation to get our average net fee and what our actual internal rate of return is from age 50 to 80 over those 30 years. You can see here, we ran a pretty complex formula. If I go ahead and click this number here, if anyone wants to look at that, but you plug in all of these numbers, the years that you put them in and how much, and then the cash value at year 30. Once you run this, you keep guessing numbers right here in this blue box until this number here gets as close to 0 as you can get it. As you can see, the internal rate of return for illustrating at a 6.3% rate of return, so that was the illustration rate that we ran on that policy, the IRR was 5.69684%. So in terms of a net fee, I did the illustration rate minus the actual internal rate of return rate, and we got our net fee of 0.603% a year. So when a lot of people are looking at the difference between this or a managed or advised account, they might think, wow, a financial advisor, for example, is getting a 1 to 1.5% fee a year. That's a lot cheaper than your 24% in an IUL in the first year. But over the course of 30 years, what you're seeing here is we get 0.603% as a net fee and no taxes because IULs are growing completely tax-free versus the fee we mentioned that a financial advisor is charging. So are they fee heavy in the beginning? Absolutely. Over the long haul, not at all. If you are looking long-term and not shooting for instant gratification, that's when this less than 1% fee that gives us an additional death benefits, no taxes, liquidity that can be leveraged, I think you can start to see past those early year fees, and that's what it takes to be successful is patience. If you're tired of taxes and market volatility and this was helpful and you want to see what would this actually look like for my own scenario, feel free to book a 20 minutes quick consult with myself down below. I'm happy to do that. Otherwise, subscribe and I will see you in a future video. Bye-bye.